Hello, everyone. Good morning, good evening. Depending on where you are, I am Yie Ying from Tricor Trust, and I'm your host for the webinar today. A very welcome. And as you can see on the screen, the topic of today's webinar is the essential checklist for moving to or investing in Canada. And it will be a sharing of about 60 minutes, which includes 10 to 15 minutes of Q&A. So please, at any time, send your questions through the Q&A box. And as we were promoting this event, we received requests to organize webinar for moving to or investing in Australia. So if you have other topics that you would like us to organize a webinar for, there will be a QR code at the end of the webinar, which will lead you to give us some feedback, and that's where you can send your requests. So before we start, now here's some fun facts for you. Do you know that there are 2 times more Hong Kong-born people lives in Canada than in the UK? And do you know that approximately 300,000 Canadian who lives in Hong Kong, 70% of them still have family who lives in Canada, and about 60% have planned to move back. And as in 2019, Hong Kong was the top 20 destinations of Canada's foreign direct investment, and Canada is the top 10 for Hong Kong. So after all the migrations and reverse migrations since the 19th century, the ties between Canada and Hong Kong remain strong. And we receive requests for Canadian-related planning quite regularly. And that's why today, together with my 2 guests who joined me, we aim to provide you useful information relating to the topic, and not just from a tax planning angle, but also from the cross-border wealth management. So let me introduce the first guest. Now, Iggy Chong is the head of private banking for Greater China, RBC Wealth Management, Hong Kong. So Iggy is a veteran banker. He started with RBC in Vancouver back in 1980s. Other than RBC, Iggy also held senior positions in Coutts. So Iggy is an active committee member of the Canadian Chamber of Commerce in Hong Kong and a longtime member of Vancouver's Board of Trade. During his spare time, Iggy runs. He co-founded a running club that organizes the iconic Victoria to Peak Challenge, and I just found out that the event has been running for 11 years. Now, our second guest, Wei Kang, the Counsel from DLA Piper. And Wei is a senior advisor serving high net worth families. And she is also very familiar and experienced in varieties of corporate transactions, which include M&A of private corporations, restructurings, and trust planning transactions. So Wei was admitted in practice in British Columbia, Canada, before she became a registered foreign lawyer in Hong Kong now. And prior to joining DLA Hong Kong, Wei practiced global wealth management and commercial law in Vancouver. And this is me. And if you're interested to find out what I do and the services that Tricor provide, feel free to drop me a message and we can meet up for a chat or have a phone call. So let's come back to what we're going to cover today. Now, we're going to start with a brief introduction of what is a trust and the purpose of setting up a trust. And Wei will cover the principle of Canadian tax and planning opportunities. For moving to Canada, we're going to use a case study to elaborate the planning.
Sorry, guys,
Sorry.
Yeah, sorry. I'm doing 2 things.
All right. Okay. So, yeah, so moving to Canada, we will use a case study to elaborate the planning that you can do before moving to Canada and how RBC support the Asia global families. And for investing in Canada, we will cover what are the considerations when deciding the appropriate structure to hold the investment and the value propositions of RBC Commission's commercial banking in Canada. So let's get started with the first topic. And I believe majority of the audience is rather familiar with this topic, so I'm going to just go through it very quickly. So trusts is created by the settlor, who most of the time is the owner of the assets, and decide to transfer the ownership of the assets to the trustee. And trustee will in turn hold on to the assets for the beneficiaries that the settlor wishes to benefit. Now, the terms on how the asset should be managed will be stated in the trust deed. And it is common for the trustee to set up a holding company that serves as a vehicle to consolidate and hold the assets that the settlor wishes to transfer to the trust. Now, the reason or purpose of setting up a trust is even more apparent for family that is transoceanic. Now, a trust serves the purpose of consolidating the assets, and the assets as held under the trust will not go through the probate process, and it will be protected. And trusts will also help the settlor in planning the successions of their assets. And depending on the relevant tax law, the trust may sometimes be used as a tax planning tool. And today we're going to focus on Canada. So Wei, could you share with us some general principle of Canadian tax and what are the planning opportunities?
Okay, thanks, Yie Ying, and thanks everyone for joining us. It's definitely a pleasure to be here, and very happy to share. Just to set the stage for our later on discussions, I think it's a good idea for me to give an overview of the Canadian tax principles, especially applicable to people who want to immigrate to Canada. You probably all know that Canada is a country that tax people's income on a worldwide basis. But there are actually two aspects of it. The first aspect is worldwide taxation. So that means that if you are a Canadian tax resident, then doesn't matter where you earn the money, even if you have a bank account in Hong Kong and it's sitting there and collect interest, or you buy and sell stocks anywhere in the world and you make money, then you have to add all of this into your taxable income. The second aspect of it is the reporting obligation. And that is something perhaps for those of us who are based in Asia, we're not too familiar with because, we usually don't do it. But in Canada, and I think also in a lot of countries where also there is a worldwide taxation regime, there is also a reporting obligation if you own assets overseas. Largely speaking, if you earn money, well, if you have cash, if you have bank accounts outside of Canada, doesn't matter whether these accounts are collecting interest or they are making any gains, as long as the aggregate exceed $100,000 Canadian each year, then you have to report it. There's a separate form for filing this kind of overseas assets. Mm. And also, there is a reporting obligation if you own a company or companies outside of Canada. So for high net worth clients, often these two requirements are often overlooked simply because we're not used to it. Mm. And later on, I will discuss more about what can be done to deal with it in terms of a planning angle. But just be aware that, for example, if you own a company in Hong Kong which has, say, 50 subsidiaries in Hong Kong, mainland China, all over Asia, if you become a Canadian tax resident, each year you have to file financial statement for each of these subsidiaries and the Hong Kong holding company to the Canadian tax authority. If you don't do it, there is a penalty. I know a lot of clients, especially for us in Asia, we like to make investment in real estate. Mm. So the real estate taxes are another aspect. It's actually separate from what I just discussed, because usually the real estate taxes, they are taxed locally. Sometimes they're imposed at the city level, sometimes at the province level. So depending on where you are, you really need to be you really need, you need to watch out for these taxes, especially if you're going to the popular areas like Metro Vancouver or Metro Toronto. You know, in both places, there are foreign buyer taxes. There in Vancouver, there is empty home tax, speculation tax, school tax, all sorts of things. In Toronto, you know, just to give you an illustration, in Toronto, if you do not have a Canadian PR or citizen, if you are an offshore company, then you have to pay 15% of the value of the purchase price, basically as foreign buyer tax. In Vancouver, that tax rate is 20%. And but I have to say there is certain advantage. There's still an advantage in being a Canadian tax resident. And one of the major advantage is that only Canadian tax residents can buy and sell principal residence in Canada and do not pay capital gain. But it's limited to 1 residence per year. And you have to, you know, there are other requirements, you know, you have to live there at least for some time for a year. But this tax exemption is only available if you are a Canadian tax resident, and also if you own the property individually. You have to directly own it. You cannot put it into a trust. So for this reason, as a very generalization comment, if you are going to Canada, moving to Canada, and if you're only buying 1 or 2 properties, residential homes for personal use, is better from a tax perspective to own it directly. Sometimes for other considerations, and there are other ways to deal with it if the clients have asset protection concerns, but from a tax perspective, sometimes it's just easier if you own it. There's more flexibility. You can claim the principal residence exemption when you sell it. But if you want to do the tax, if you want to put it into a trust, then there is a whole lot of new considerations. And later on, I'll give you more illustration.
Okay.
So I think if you move on to the next slide, I'll just give you an idea, because I know that for those of us in Hong Kong or in Asia, we are not really used to paying this kind of taxes. And to be frank, the tax rates are still going up each year. And especially with the recent pandemic, you know, the government all over the world is giving away money, but where does the money come from? So everybody expects that the tax rate will still go up as a trend. In BC, British Columbia, and Ontario, these are the popular provinces for immigrants from Asia. Pretty much, if your annual income goes over 200,000 Canadian dollars, you are paying over 50% in taxes. If you make less than that threshold that I put on the screen, then it's an incremental tax rate. You know, it starts somewhere around 15%, and it goes up to all the way to over 53%. The only discount is where if the gain is a capital gain. So basically, if you make capital gain, then half of it. So if you buy and sell a house, but that house is not your principal residence, but assuming that this is for long-term investment, not to flip a house, then if you make $1 million, then you only report 50%, you know, 500,000 of that into your taxable income. So there is a discount for capital gain. But overall, you know, for high net worth people who regularly, you know, again, on worldwide income basis, you know, they easily go over the threshold, and above that, you pay over 50%. There is no gift tax in Canada, but a lot of, especially in recent years, there is a trend. Well, there are signs that, well, there are signs that there is more audit from the tax authority for the taxpayers who receive from time to time large amount of gifts or transfers from their family or friends. Well, partially it's because in Canada, And I think Iggy may know that as well. Every bank transfer that goes over a certain threshold, and the threshold I think is only 100,000. It's not very high. It automatically gets uploaded to a database. It automatically gets reported to the Canadian Tax Authority. So they're sitting with a large database of all these transfers. But on the other hand, there is a lot of research that found out that a lot of the high net in Vancouver in particular, where the houses are most expensive, the taxpayers in those zip codes do not pay the highest amount of taxes. So there has been more audit this way. So the short story is, if you expect to receive a lot of gifts by cash from overseas, correct, that gift is not taxable, but it is better if you can document it, and also if you can explain how does this gift come from, and how did the person who make you the gift, how did that person make the money? Is this after-tax money from that person? Final comment is on the inheritance tax. There is no inheritance tax in Canada, unlike in the US, but there's another way to tax it. And that's just to, to me, in a sense, it's still an inheritance tax, but we just don't call it that way. So when a person passes away, then all of your worldwide assets are deemed to be sold at the fair market value on that date. So your executor will have to calculate the tax that you have to pay. It's basically a resulting capital gain tax. After you pay the tax, and the other debts, can then the executor just make distributions to the beneficiaries. Sometimes this gives rise to a cash issue, because if you own real estate that has appreciated and there is a capital gain that your estate has to pay and there's no cash, sometimes you may have to sell the estate, the real estate.
Great. So thanks, Wei. These are very useful information. Can we now use a case study to sort of further elaborate the information that you just shared with us? So now we have a case here, a Hong Kong family that's made up of father, mother, 2 children, a grandmother and aunt. And the immediate family, which is the parents and the 2 children, they're planning to immigrate to Canada. So the assets that they have in the family is active business in Asia, financial assets, and residential properties both in Canada and in Asia. So their priorities is really to make sure that they are financially prepared for the move, minimize tax exposure, maximize wealth, and also because they'll be traveling between 2 countries, and they are looking for wealth managers who can manage their wealth and that they plan to keep in both sides of the planet. So Wei, can you share with us, in terms of the tax implications, how can they plan for the move, and would setting up a trust help with the tax planning?
Okay, thanks, Yie Ying. So I think this is a very good example where we can put what I just set out as the general tax principles into play by thinking how this case can be planned given the tax regime in Canada. Because a Canadian tax resident, because once you move to Canada and you become a tax resident, because then you're taxed on a worldwide basis. For a high net worth family, especially in Asia, where there are extensive family ties and probably extensive wealth by the whole family, it is important to separate the ownership of the assets. Basically, the assets that are directly personally owned by the family members that are going to Canada, they are taxed worldwide and you have to report it. So you have to separate it. But if you have assets owned by, say, parent, grandparent, or other family members who are not going to Canada, but for other reasons, they are still ultimately going to benefit you or your children who are going to Canada to study and live, then we should make I call this asset B for a separate planning. So you really have to make a clear distinction in terms of the ownership of the assets. And sometimes this may take some time.
Mm.
For the assets that you own personally, then you have no choice but to bring to Canada and pay tax on worldwide basis. Then there are two things that you can think about. The first of all is something that you have to do is you have to keep a record of the value of these assets, because for Canadian tax purposes, that is the cost if later on you sell it. So if, for example, you own a few apartments in Hong Kong, you do not intend to sell them now because you bought them quite a few years ago. You still want to keep it for the long term. But if you're moving to Canada next month, it's better if you keep a record of the value of the homes, maybe get in touch with a realtor or an appraiser to get the value, because later on, say 5 years later, when you sell it, but you're still in Canada as a tax resident, then you have to report the income, the capital gain to Canadian tax authority. But your cost is not the cost of the back 5 years ago when you bought it, but that's the cost is when you become tax resident in Canada. So you should keep a record of that. Mm. The second point that you can think about for asset A is how you combine this principle of taxation with the principle for tax residency. Unlike in the US, in Canada, you are taxed, in Canada, the residency is based on fact, and it's based on domicile, based on residency itself. So the day when you enter Canada as a PR, permanent resident, is not necessarily the date when you will become a tax resident. For some families, especially for families who have active business back in Hong Kong, you may not be able to make the move in one trip, right? Especially for the spouse who is still looking after the business back in Asia, you may have to travel back and forth. You may have to make a few trips to settle down. So there is some flexibility in forward planning in terms of tax residency, and that ties into the cost base. Sometimes if you own a lot of stocks, maybe you can time it, try to enter Canada on the day as a tax resident when the stock price is higher, then your cost is higher. A second thing that you can think about if you have business that you have to run in Asia in relation to tax residency is if one spouse still needs to come back to Asia to run the business, and if this spouse owns a lot of the assets, you may consider have this spouse stay in Canada, in Hong Kong as a Hong Kong tax resident, but the other spouse with children who will enter Canada and live there, maybe work, maybe study, they can be the Canadian tax resident. As a forward planning issue, this is possible. If this is something that's already happened, that's really a fact matter. We cannot, that's not a legal issue. But if you're planning to make the move in the future, this is something that you can think about, because for a lot of the business people in Asia, it may not even be practical for this busy businessman to live or stay in Canada for more than 1 or 2 months on each trip. So this is also where it may be, from a tax perspective, it may be doable for one spouse with significant asset to stay as a Hong Kong tax resident, and the other spouse and family members to go to Canada as a long-term tax resident. You may have to get some advice on how to plan your life to meet the requirements, but it is possible. From a practical perspective, this may be a challenge for family life, but this is possibility. So after tax residency, we look at, suppose that this person, this family member who's going to Canada does have to bring a lot of assets into Canada. So I have listed 2 issues that have planning considerations for you to think about. First of all is, if you own a company in Hong Kong that has active business, it runs, you hires employees, you make, trades, you have a trading business. If you have an active business, the money that is owned by that business is not going to be taxed in Canada until that money has left the company and be dividend back to Canada. So this is where, if you can expand your active business, you can defer your tax in Canada. And also there is a Hong Kong Canada tax treaty, which I can discuss later. Because of the tax treaty, sometimes it is better for you to set up a Canadian holding company to hold the Hong Kong company that has active business. Then the dividend goes back to Canada, which will be taxable in Canada, can have a lower withholding tax. If you're a Canadian tax resident and you have a lot of cash and investment portfolios, because in Hong Kong, a lot of the high net worth clients, they either themselves personally, or they may have a BVI company that owns a lot of the portfolios or stocks or cash bonds. For this kind of assets, you may consider transfer them into a trust for asset protection. This will also give you, under the current tax rate, about 5% tax savings if this trust is an offshore trust administered by a trustee based in Hong Kong or an offshore jurisdiction. This is because my earlier slide showed you the tax rate in BC, in Ontario, as 53%. But an offshore trust that has received your gift and then has to pay tax in Canada is called a non-resident trust, which is deemed to be a Canadian tax resident. The tax rate that's applicable to this kind of trust is 48% right now. It changes every year, but every year it gives you a few percentage of savings. So this is where I admit the tax advantage is not very significant, but it does give you a tax saving, and it also gives you added asset protection because these assets remain in offshore. You can benefit from the asset protection features of the offshore jurisdictions. You may also be able to benefit from the investment choices. Hong Kong and Singapore in Asia, there's probably in general more opportunities for investment. So this is where, given a lot of considerations, this could be a good choice. A lot of the clients, go ahead.
I just try to sort of pause you there and sort of sum up what I just heard. So it sounds to me the best way to plan is we have one of the family members or remain outside of Canada. That's one way, right? So
that's one option. Yeah.
So and buy some time, and then or ultimately if both of them, I mean the partners, the parents are moving, the whole family are going to move to Canada and become a Canadian tax resident, a offshore trust still gives some marginal tax saving. Am I right to say it? Okay.
Yeah.
Okay, great. Thanks.
Okay, now I go over for 2 minutes. I go over the asset B in this diagram and these are the assets that are not owned by the family members who are in Canada, but they are owned by your family members in Hong Kong. But if these assets ultimately are intended to benefit the Canadian family members, and also that where, as mentioned earlier, where one spouse with significant assets is going to stay as a Hong Kong tax resident, then this is where these members who own the assets can settle an offshore trust for the benefit of the Canadian family members. And this is, so-called granny trust. A lot of you may have already heard about it.
Mm.
The key Canadian considerations in this offshore trust arrangement is, first of all, the trust has to be a discretionary trust. There are a lot of the types of trust, but for Canadian tax purposes, it has to be discretionary. Second, the Canadian tax members cannot make decisions for matters, including investment matters relating to the trust. It is more desirable to have discretionary accounts, discretionary investment accounts for an offshore trust. So the Canadian family members needs to be hands-off, have a hands-off approach. When we plan for this kind of structure, of course, we need to talk to the family to make sure that they do have sufficient oversight into the structure. But there's a balance where you want the tax benefit and also you want the asset protection aspect. And the third of it is that in this structure, if you plan it correctly, the Canadian family members can receive these distributions tax-free. So all the gains, unlike what I said earlier, the capital gain, the interest, the dividend, they will stay in offshore as an offshore account with no Canadian tax. If the Canadian family members need to spend money, they need money, then you can make a distribution to them. That distribution can be tax-free. But you do need a trustee who has experience administering this kind of trust, because the distribution has to be capital distribution. And it's much easier if you find a trustee that has the experience of administering granny trust.
Right. So is it correct to say that it will be better for the granny trust to hold the portfolio or financial assets in Hong Kong, which is not a Canadian bank account? Am I correct to say that majority of the assets should be held outside of Canada and be held under the granny trust?
Yes. The trustee and the signatories they all have to be offshore.
Okay.
Sometimes, for RBC, especially for Canadian banking institution, they may have banking operations in multiple countries. This granny trust could open an investment account in a Canadian bank, but the same principle apply. The signatory, the decision makers have to be offshore.
Got it. Okay. Thanks, Wei. So is that all for the tax planning perspective?
Yes.
Okay, fantastic. Thank you so much. That's a lot of information. And Iggy, now I'm going to turn to you. So how do you think RBC could address the other priorities of a typical Asian global family like this? They may be still living in both places and traveling between the countries and have assets in both places. So can you share with us the value proposition of RBC in serving them?
Yeah, thank you so much, Yie Ying. And first of all, really appreciate the opportunity to have this time to talk with you as well as with Wei Kang. So just to set the context, maybe I can just give you a brief overview of what we do at RBC and in Hong Kong in particular. And I'm referring here to slides 14 and 15. I won't go through them in detail at all, but just to give you that sort of a broad overview. Hopefully, most of you will know that RBC is indeed the largest bank in Canada, and in fact, one of the largest in the world. A very rare bank that has a AA credit rating. So we're all about that sort of long-term stability and security. In Hong Kong, we have a number of businesses, and they're mapped out on slide 14, which, as I say, I won't go into the details, but we're about 300 staff in Hong Kong and another 150 or so in Singapore. Specifically in Hong Kong, our wealth management strategy captures what you alluded to earlier, Ying, which is Asia's global families. And this is really a very key headline for us, a headline strategy that I think is particularly relevant today. And what that means is that we're not trying to be a regional bank. We're not trying to be a local Asian bank by any means. We're really the Asian arm of a North American bank, particularly strong in Canada, and most people don't know it, but actually very, very strong in the US. So globally, we rank among the top 5 in terms of assets under management. And in Hong Kong, I can tell you pretty much every day, we're talking to clients like what Wei has described and like in the case study you outlined, Ying. So that's maybe just to give you that kind of headline. Just to give you maybe something more concrete. So literally in the last 2 weeks, we've talked to 2 families who fit within that description that that Wei just went through. A set of siblings that are going back to Canada, in the process of going back to Canada. They're sort of in their 40s and 50s, while the parents, who are in the 70s and 80s, are remaining in Hong Kong. So in that type of scenario, where we provide, I believe, value-added role to hopefully our audience members and to partners and clients, is really the implementation of the planning and legal advice that Wei has talked about, working with partners like yourself at Tricor, Ying, the implementation and I would call it like an overwhelming convenience for the client in having all their financial affairs consolidated with a safe, secure, and professional bank. You know, Wei alluded to a few key things that maybe Hong Kong people won't be as familiar with, the differences in Canada in terms of tax reporting, record keeping, issues around Hong Kong, Canada tax treaty, for example. They're not going to be many, if any, other banks that can deal with that type of additional complexity, but we can. So if you can just picture this family of 3 siblings, parents remaining behind in Hong Kong, properties in both locations, financial assets moving back and forth, where we've come into the picture and help these clients is to be able to really deal with the basic aspects of just the bank accounts in Canada, the bank accounts that will remain in Hong Kong, the record keeping to some extent, and also for those families that have property, as Wei mentioned, it's a very, very common asset class held, a popular asset class. We have the ability to help them potentially optimize in terms of income and tax deductibility issues, which Wei would be an expert in, by having or providing credit facilities as well. So credit facilities, whether the property is in Hong Kong or the property is in Canada, we can all handle it under one roof. And that's really sums it up. I think this convenience, this consolidation, and this expertise to be able to help the families navigate through this sort of very complex situation. I think I'll leave it there in the interest of time for the time being. Ying, back to you.
Thank you. Thanks, Iggy. So we're gonna change the theme a little bit. So now we're gonna look at, it's no longer about immigration planning, but it's more of investing in Canada. Say we have like a Hong Kong or investors. We're talking about non-Canadian person here, and was looking to invest in Canada. It could be commercial properties. It could be family business expansions or private equity investment by the family office. Now, their priority here for those investors would be to find the appropriate structure, again, to minimize tax exposure for the investment or businesses, and also definitely going to look for a trustworthy wealth manager to help them to manage and consolidate their commercial needs. So again, back to you, Wei. So what are the key planning considerations in this scenario?
Thanks, Yie Ying. The considerations for this type of investment is what I listed here. This is where this is where there is actually a lot of room for planning, especially for high net worth families who are in Asia, whose family members are diverse. They may live in different countries, and also where their assets are diverse, meaning that they do not just invest in Canada, they invest in a lot of countries. And this is where, even though in Canada, there is a worldwide taxation regime, and to be very frank with you, the domestic Canadian tax planning opportunities have been basically shut down. There has been very little each year. But if we can make use of the facts of the high net worth family or family business in Asia, we can make use of the cross-border tax rules and also the Canada-Hong Kong tax treaty to achieve a lot of to achieve significant tax efficiency. But this is where you have to be careful about two things. First of all, we have to consider asset protection and estate planning. Not only because it's good, because as a family, you cannot just think about tax. You have to think about long-term succession planning, how you're going to pass this down to next generations, and the safety of your assets. But also in this global trend of each year, you'll hear the news about the BEPS, and also there's a lot of there's a lot of headline news about tax evasion, about multinational companies having this or that tax regime. So in order to deal with the tax risk, a family need to have a genuine interest in estate planning. So that's where you have to think about a trust structure. Second, you really need advisors who have, and not just tax and legal advisors, but also, for example, financial advisors who are experienced in cross-border things. So you need to have this group of trustworthy advisors who have done this, who can guide you through the process. And then that will make things a lot easier. Now I show you two structures that to illustrate this, some of the plans that we have implemented for our clients who over the years, turn out to be both tax efficient and also they satisfy clients' other objectives. First of all, this is an example for investing in commercial real estate in Canada. This is not, I'm not saying that all the commercial real estate I'm not saying this is the structure for all the commercial real estate investment, but for certain families, this works. See, we have an offshore trust. Again, this offshore trust has to be settled by a non-resident investor, and also the funding, the contribution have to be made by non-resident investor only. So this, imagine this can be a Hong Kong company owned by your family business, or this can be the granny trust that I just outlined if you have the facts to set up a granny trust. So now we are going to buy real estate in Canada. Say you want to buy some office units, or you want to buy an office building in a city in Canada, and then you want to hold it for the long term to collect rent. This is where this structure will work. You set up an offshore structure to directly own the commercial real estate in Canada. The offshore trust will receive the funding to make the purchase by way of a loan and a capital contribution. Now, in reality, all of this money will come from you, your Hong Kong company, but we will plan it such that this Hong Kong company or this offshore trust, whoever is the contributor or the person, will make the contribution by way of a loan with interest and by way of capital contribution. The result is the rental income in Canada will be offset, not entirely, but to a certain extent by the interest payment of the offshore trust. If this project, if you say, okay, that's just the family money, we also need bank financing, that is fine. You can get bank financing on top of it. Then there is additional interest deduction. So this, by the end of, if you hold it for a lot of years, this can be tax efficient. The trick is, if you do not hold it for the long term, there is a hassle when you sell it, because the seller here is a non-Canadian entity. So there's withholding tax, there's some hassle in doing it. But if you hold it for the long term, it is worth the hassle. The second caveat is that you have to, because this is a Canadian real property, the offshore trust has to deal with it every 21 years. And that's just because of a specific rule in Canada. So that's just something that you keep it in the background. Now I look at the second example for the private equity investment in Canada. This is where sometimes some clients may have this confusion, because everybody knows Canada is a country that taxes people worldwide. Yes, but then they say, oh, okay, if I'm a Hong Kong person, a Hong Kong company, and I want to, I want to invest in, say, a software company in Canada. And this is where, I have a deal, I subscribe for, say, Class A shares for, say, $2 million, as an investor. Then 3 years ago, maybe Google will buy my shares for a gain. Do I pay Canadian tax or not? The answer is no. The answer is no. So if you have a Hong Kong company or offshore company that invest in company, in private equity investment in Canada, and then you sell it, as long as these, to a large extent, as long as these target companies in Canada do not own significant real estate in Canada, they do not own significant natural resources in Canada, then there is no capital gain in Canada when you sell it. So this is one advantage. Second advantage is, if in case this is investment where you expect there will be profit that will have to go up to you as a shareholder by way of a dividend, then you can make use of the Hong Kong-Canada tax treaty, where that dividend is subject to only 5% withholding tax. So say here in the diagram, if company A wants to declare a dividend to the Hong Kong company of 100 Canadian dollars, then you only pay $5 to the Canadian tax authority as a withholding tax. Hong Kong company will get $95. And to my knowledge, Hong Kong company does not pay tax on the $95 in Hong Kong, because this is a dividend income from outside of Hong Kong. So, but to plan this is not as easy as just say, oh, I get it. I just need to have a Hong Kong company and buy and sell my shares in Canada. The tax treaty has a business purpose test. So here you see at the top, the ultimate shareholder, the beneficial owner of the Hong Kong company needs to be a Hong Kong tax resident. If the client is a PRC tax resident, a PRC resident, that person cannot just set up a Hong Kong company and then say, oh, okay, I get a 5%. No. For asset protection reasons, you can put a trust on top of it. Go back to my earlier comment on the granny trust. However, as a cautious note, that trustee is better for that trustee to be in Hong Kong as well, for the same reason that we need to maximize our chance to use the Hong Kong-Canada tax treaty. So the tax treaty, it has been a sensitive topic in the tax world. There's a lot of discussions and a lot of focus on tax treaty shopping. So we do not want to set up the Hong Kong company as a conduit just to make use of the reduced withholding tax. But if the family is already in Hong Kong, if they already have a Hong Kong business, this is a good way of structuring it.
Fantastic. I think this gives us a lot of good news. Like there's definitely a way to minimize the tax exposure. I just have one small question on this slide here. It was just minority shareholdings. Can you maybe elaborate? You know, what is the percentage would be considered as minority shareholdings?
There is no specific requirement here, because when I say minority, simply because a lot of the private equity investments are by way of a minority shareholder. But if the Hong Kong company does want to acquire a company in Canada 100% or 50%, sometimes for practical reasons, you want to have a Canadian holding company and then you make further investments. That's just because when you want to make that kind of investment, you may want to have the money stay in Canada, because then you're very serious about making investments in Canada. You may want to make further investments from time to time.
Okay, thanks for the explanation, Wei. Now, back to you, Iggy. So, can you elaborate a bit more, like what's RBC Commercial Banking in Canada, and what's their value propositions, and how can they support the businesses or the investor like this case?
Thanks so much. Thanks so much, Ying. So we're on slide 20 and 21. Again, I won't go through that, but just pick up, in fact, best if I pick up from the themes that Wei has mentioned. The services themselves are not really the differentiating factor in terms of how we can help our clients. I think, the commercial solutions are the type of solutions you would expect to find in a large Canadian bank, and in our particular case, the largest Canadian bank. But what I want to emphasize is, again, that theme I mentioned earlier about, for the client, is extremely high value added to be able to deal with, as Wei put it, a team of advisors who really know what your issues are, what the circumstances, and what the planning opportunities are, like the Hong Kong-Canada tax treaty that Wei mentioned several times. So in the context of commercial services, Ying, what we provide, what I put on the slide here is from our commercial teams in Toronto and across the country. Sorry, we specialize in the major sectors that investors are interested in Canada. Obviously, commercial real estate often comes up right at the top, but we also have seen increasing interest from investors, not just in Hong Kong, but also China and Taiwan as well, to some extent, in other sectors like educational services. There have been cases of private schools in Canada being acquired by investors wanting to expand there. Retail is an obvious one, and also agriculture, food production, a common sector as well in Ontario, and growing, and really very fast growing, is again a sector that Wei mentioned earlier, is a high-tech sector in the Ontario kind of Toronto, Greater Toronto area as well. So in all these respects, RBC Commercial Services, we have the whole range that you'll see in slide 21 of asset-based lending, M&A, financing, the whole range of commercial services, as well as some really more advanced, I would call them leading edge disruptive technologies that we won't have time to get into here, but across the whole spectrum, Ying, that we can help businesses with. I'll just finish with that same thought, really, that around complexity, compliance, the reporting, so if a family, and we are dealing with families like this, have to plan properly, need to and want to plan properly, there's just tremendous advantage in working with a team. I think Wei mentioned that too, a team of advisors who really know the issues. And so we can help with the wealth management side, implement the plan that you and Wei would advise the clients on, and provide them a lot of convenience by having it all done in one safe, secure bank.
I totally agree with you. And I think it's really important for the client to have a team of professional and people who knows the things that's ins and out to help them. And it is actually a very complicated situation that the client sometimes may not be aware. So with that, I would like to just thank both of you for taking your time joining me today. And I'm sure the audience would have already received a lot of valuable information and tips. So again, like I said earlier, this is a QR code. Please give us your feedback, and we look forward to hear from you. And I'm not going to take up any more of your time, and you can go back to the news about the US elections.